Okay, and welcome back. So look, when you're dividend investing, one of the key things to be looking for is safety and security. Now, one of the most important things there is that there's a range of different companies. Now, some companies pay dividends sporadically, some companies increase dividends on good years, then decrease the level of dividends when they have bad years. But there's also a class of companies called the Dividend Aristocrats, or Dividend Kings, who've been raising the dividend consistently year in, year out for 25 or even up to 50 years. Now, for example, some companies have been raising dividends like General Dynamics for about 25 years, while others on the other end of the scale, such as Procter & Gamble, have been raising dividends for 66 consecutive years. Now, when you think about that, this is a company that you can invest in, that you can trust in, and they are going to be doing everything possible to maintain this record. Now, for the companies, it brings all sorts of benefits. Consistent dividends means that there's going to be increasing interest in purchasing this from dividend-focused investors like myself, and that's always going to help lift the prices. Now, when we look at this, there's a range of different companies. I'm going to look at several today. Some of these are really good value in my mind, and others are, they're okay. So first off the bat then, one that's in really nice value, Medtronic. So this is a medical devices manufacturer. As you can imagine, here in 2020, we can begin to see that the earnings are in decline. Had a really good year up here into the beginning of the 2022. And then growth looks like it's going to be increasing a little bit here. Now, this orange line represents a 15 times price to earnings ratio. It's a good level, and as you can see, this orange line, this earnings level, has been increasing fairly steadily up until the sort of the pandemic period. Now, the white line here is the increases in dividends as well. I mean, the dividend level being paid out, and that's increasing beautifully. Now, when we start to look beyond this as well, we can also begin to get a sense for how much they increase dividends and when they increase dividends. So if we flick over here to the performance tab, as well with Medtronics, we can sort of see they've got some pretty good 8% increases in dividends over time there. And when we begin to look at this, they have a dividend yield of about 3.44%. So we're talking about a good dividend yield to start off with, and inflation beating dividend increases. Now, they've got an S&P credit rating of A, so this is a big company as well, managed. It's $103 billion by market cap. Stable, good credit rating. So this is a company we can probably begin to bank on. Now, when you begin to look at this here, they're trading at about a 15 times price to earnings ratio. Now, with the fast graphs, I can click here on the forecasting calculators, and I can begin to see if we expect the company to trade up to where they've traded in terms of the price to earnings multiple over the past 5 years, we would expect that to be about 18 to 19 times. Now, this 18 to 19 times, if we look at the 2025 year, assuming the analyst estimates are correct, and assuming that the price to earnings ratio returns to this 18.8 times level, we would expect a total rate of return of about 50%. Now, that's comprised of about 41% capital appreciation plus dividends coming through to us as well, and this is about an 18% annualized rate of return. Now, really important to note, that's not guaranteed. Prices could still trend down for a time. Prices might not reach this price earnings multiple at this time. And of course, the estimates for the earnings may not be accurate and may not be realized by the company. So take this with a grain of salt, but it gives you some indication of the strength of the earnings here. We know it's a dividend aristocrat. We know it's going to keep on paying these dividends. And it's a fairly stable company with fairly good growth prospects. We've got a couple of years here in the 2025 year where a percentage increase of about 9% of increase in earnings is expected. We're still expecting another 6 months with a decrease of about 5% earnings. And we can see here in terms of the dividends as well, as they are expected to increase with an E next to it for an estimate. Another really important thing to note as well is these earnings have been decreasing here in this lower panel. We can see the recent updates or edits on the analyst estimates for earnings out for 2025, and there's about 18 analysts projecting earnings or estimating the earnings out that far. We can see they've decreased from about 6 months ago. They expected about $6.55 per share in earnings. The EPS estimate was revised recently to about 6.28, and it's estimated now to be about 5.95. So it has seen a decrease. There are more stable companies out there. So keep this in mind. These earnings estimates may go down. But we're talking about a good credit rating for the company, a big company, and a dividend aristocrat. So what else is out there for dividend aristocrats? Procter & Gamble. Oh, this is one of my beautiful favourite companies. So Procter & Gamble, as I said, has been paying increasing dividends for more than 6 decades. We can see this beautiful line here just steadily increasing. Credit rating of an AA-, a market cap of 300 plus billion, dividend yield 2.5%. And we can look back over time and we can get a sort of a sense here for recent dividend raises being about 7 or 8% per year dividend raises. So we're talking about some fairly healthy dividend raises here in the last couple of years. So what do we get for this? Well, we can see already that at a 15 times level, it's far above that. We're talking about a blended PE of about 25 times. I personally think that's very, very high. I'm not going to be touching it at this level. If it reached this blue level here, that's about a 20 times PE, which is sort of the price it's sort of traded at. So you can see it sort of consistently trades above the orange 15 times PE line. Now, if it was to return to that even sort of a 23 times, which is what it's performed at over the last 5 years. By the end of 2025 financial year, we're talking about a total rate of return of only 14% or about 5% per year. Now that includes both expected capital appreciation as well as dividend payouts. We can also begin to see there's a reasonable decrease here in the expected earnings as well, just as we saw with Medtronics. Now, again, Procter & Gamble, it's a company which has strong dividend history, really strong focus on paying out dividends and growing those dividends year in, year out. So a couple of other options, and of course I'm not going to go through all 65 dividend aristocrats. I don't have time for that, you don't have time for that, but just to give you a sense of what you could be looking at. Johnson & Johnson. So I do own shares of Johnson & Johnson. It's currently trading at about 17 times price to earnings. It's a company I like. It's got a good, consistent record here for earnings growth, with the exception again with the COVID year. What might we expect? Well, if we expect prices to maintain this normal multiple here that they've experienced over the last 5 years, that normal multiple is pretty much bang on what it is now at about 17.66. So we'd be expecting just the regular growth of the company with the earnings growth expected. We'd be talking about a total rate of return of about 13%, or about only 6% year on, year out, annualized rate of return. So is that good? Well, again, we can sort of see a decrease in the expected EPS. This has been revised downwards as the analysts are beginning to reevaluate the economic circumstances that we're all operating in. So again, Johnson & Johnson is a nice long-term core holding for many people, and when we begin to look at the historical performance, it's quite a consistent, it's always traded within quite a narrow band over the last 20 years, and it just keeps on growing. So it's quite an exciting opportunity, but again, quite richly valued here above this long-term normal PE ratio of about 17 times. So can we find some good examples here of other dividend aristocrats at good value at the moment? Well, Illinois Toolworks is again not an example of a good valuation at present. It normally trades at about 20 times PE, and currently it's trading at nearly 25 times PE. But again, look at this, beautiful. Standard & Poor's credit rating of A+, a relatively small company of $70 billion. And we can sort of see visually here, there's a little bit of expected growth in the future. If you're going to hold it for a long time, even at this high valuation, you might make money. But again, I like to look for companies that both grow dividends that are also available at good valuations at the moment. So let's move on. REITs. Now, REITs are a little bit different. Instead of looking at price to earnings, I'm using here on Fast Graphs the ratio with the AFFO. And that sort of, you'll see it sort of comes out with a similar type of pattern. Here we can sort of see the adjusted funds from operation, the AFFO. It's been increasing, this orange line here at 15 times, increasing steadily. So it's going, growing. We can see that usually this blue line is above the orange line. So usually Realty Income Corp has been trading at about 17.8. We can see at the moment it's a little bit lower than this 16.7. We can see the black line here. It's sort of in between the 15 times and this 17.8 times. We can see that the white line here, the dividends has been increasing. Again, A- credit rating, a $40 billion market cap company. Now the forecasting calculator here, I'll switch to normal multiple again. It's a little bit sort of undervalued. In the last 5 years, it's been trading quite richly, above even 17 times, and it's been trading up at about 19.5 times price to AFFO. Now here, if we project out to the end of the 2024 financial year, if prices normalize to this normal price to earnings, price to AFFO ratio, and these analyst estimates for AFFO met, we'll be talking about a 35% rate of return, or an annualized 15%. Now that's quite nice. Again, you'll notice there's been some recent weakness here in the AFFO projections, and this is a relatively slow grower like many REITs as well, with a sort of a 2023 growth of about 2 to 3%, 2024 growth of just over 3%. So a nice slow grower. So is this the best that we can do? No, it's not. So a stock that I've just recently added to our family portfolio is Essex Property Trust. Now this isn't the Dividend Aristocrat with the longest track record, but like Realty Income, it's got a track record of about 28 years of paying dividends and increasing those dividends. So again, I've got this on the AFFO ratio. Unlike Realty Income with Johnson & Johnson, we can see quite a bit more variation here. The Standard & Poor's credit rating is BBB+, so reasonably good credit rating, and quite a small company at only $13 billion. Now, we can see a lot of fluctuation. Now, variation is going to provide us with investment opportunity. Now, we can see as prices reach down here to this 15 times or even lower in the depths of the global financial crisis in 2009, it gave us the opportunity to buy at lower valuations. And at the moment now, prices have been trending down strongly, heading towards this 15 times price to earnings ratio. I don't know if it's going to get there. I do know at about 16.8 times, I'm happy to start initiating a position here, which is what I've been doing for a couple of weeks. It's got a reasonable dividend yield here of about 4.5%, where you can sort of see some forecasting here of if we expect it to reach this price to AFFO ratio of what it's experienced over the last 5 years on average, which is about 22, nearly 23 times, we might expect a total gain of about 65% till the end of 2024. Is it going to reach that? Hard to say, but this is a total annualized return of about 26%. Now, I'd also like to draw your attention here again to these analyst estimates. So we've got about 11 analysts making forecasts for the AFFO out this far. And we can sort of see a reasonable level of stability here. So 6 months ago, estimates of about 14.57 adjusted funds from operation, and it's only just been it was adjusted up a little bit, and then adjusted down, and adjusted down a fraction, and it's relatively stable and steady compared to where those estimates were about 6 months ago. So in my mind, this is a Essex Property Trust as a company. As I said, I'm initiating a position in here. I think this is a nice time to invest. I'm aware that prices can go down, and in fact I anticipate prices will continue to trend down perhaps for a little bit longer, and if that happens, I'll just continue to pick up some shares. And we can sort of see here as well, the dividends are expected to be increasing at a reasonable rate as well over the next several years. So I'm starting off with a 4% 0.15% dividend yield. I'm anticipating dividends to increase, and I'm also anticipating a price increase as well, so giving me some capital appreciation on top of these dividends over the next several years. And one of the reasons I do like this, as I say, is the stability in the analyst estimates for AFFO moving forward. So look, I hope this is really helpful. Now, as a special news announcement, as we said, companies raise their dividend all the time. Now, there's been a number of companies that have been raising their dividend recently. One of these is Hewlett-Packard, or HP, ticker symbol HPQ. And they've just declared a quarterly dividend of 26.25 per share, which represents a 5% increase from their prior dividend of 25 cents per share. This gives them a forward yield of about 3.6%. So there's always these companies continuing to increase their dividends in good times and in tougher times, even like today. So this is one of the reasons why I love dividend investing. I love that cash flow, and I hope you'll join me for the rest of this journey. Now look, if this video has been useful to you, click the like button, do hit subscribe, and we'll bring you some more fabulous content soon.